The stock market. Just hearing those words can feel, well, a little complicated, right? Maybe even intimidating. But what if I told you the basic ideas behind it all are actually way simpler than you think? Today, we are going to cut through all that noise and give you a super clear guide to what it all really means. You've heard this a million times on the news, haven't you? Some reporter just casually says, the Dow is up 200 points, or the S&P had a rough day. And it's said like we're all just supposed to nod along and know exactly what's going on. If you've ever felt a little bit lost hearing that, trust me, you're not the only one. That feeling of confusion is totally normal. The world of finance, it kind of has its own language. So our goal here today is to be your translator. We're going to break every piece down into plain English, starting from the very, very beginning. Okay, so let's kick things off with the most fundamental question there is. What even is a stock? Because it's not just some blinking number on a computer screen. It represents something much more real and honestly a lot more interesting. So get this. When you buy a stock, you're literally buying a tiny little piece of that company. You become a part owner, a shareholder. That means you get a claim on a small slice of everything that company owns and every dollar of profit it makes. So yeah, if you own one share of Apple, you own a teeny tiny piece of the company that makes your iPhone. So why would a company want to sell off little pieces of itself? Well, imagine you've got this great private company and you want to expand. You want to build new factories, hire more people, grow. Instead of just taking out a giant loan, you can sell shares of your company to the public. That big event is called an initial public offering, or an IPO. Everyday investors can buy those shares, and poof, the company gets a huge injection of cash to fund all that growth. Okay, so this brings us to the big question. How does owning that tiny piece of a company make you money? Well, there are two main ways this can happen. The first one is called capital appreciation. It's simple. You buy a share for, let's say, $10. The company does well, people get excited about it, and now the share is worth $15. You sell it, and you've made a $5 profit. The second way is through dividends. If a company's making a lot of profit, it might decide to share some of that cash directly with its owners, and that's you, the shareholder. So now we know what a stock is and why it exists. The next logical question is, where does all this buying and selling actually go down? Well, it all takes place in what we call the stock market, which you can just think of as a giant global marketplace. Now, here's a really important distinction that trips a lot of people up. When a company first has its IPO, that happens on what's called the primary market. That's the only time the company is selling its shares directly to investors. But all the trading you hear about every single day, that happens on the secondary market. That's where investors like you and me are just buying and selling those already existing shares from each other. The company itself isn't even involved in those trades. You know that old image you have in your head of traders in colorful jackets, all shouting and waving paper on a crowded floor? Well, some of that might still technically exist, but the reality is that today, pretty much all of this happens electronically. Exchanges like the New York Stock Exchange or the NASDAQ are basically these huge, powerful computer networks that match buyers and sellers from all over the planet in a fraction of a second. Okay, so we've got thousands of different companies, with millions of shares being traded every single second. How in the world do we make sense of it all? How do we know if the market as a whole is having a good day or a bad one? Well, this brings us right back to those confusing terms we talked about at the very beginning. And this analogy is just perfect. A stock market index is a tool that measures the performance of a whole group of stocks all at once. Trying to judge the entire market by looking at just one company's stock is like looking at a single tree and trying to describe the whole forest. An index gives us that big picture view, that snapshot of the market's overall health. So the three you're going to hear about all the time are the Dow Jones, the S&P 500, and the NASDAQ. The Dow is the old-timer, it's the most famous one, and it tracks just 30 huge established American companies. The S&P 500 is much broader. It tracks 500 of the largest U.S. companies, which is why a lot of people think it's the best measurement of the entire U.S. market. And then you've got the NASDAQ, which tracks thousands of companies and is really, really heavy on tech. But here's a key difference in how they work. Indexes are weighted, which just means some stocks have a bigger influence on the index's value than others. The Dow is what we call price-weighted. The analogy here is great. Think of it like your final exam having way more impact on your grade than a single homework assignment. In the Dow, a stock with a higher price per share simply matters more. But the S&P 500 is market cap weighted. That means the companies with the biggest total value, like an Apple or a Microsoft, are the ones that move the needle the most. And this visual right here shows you exactly why the NASDAQ is almost synonymous with the tech industry. Look at that. Nearly half of the entire index is made up of technology companies. That's why whenever you hear news about the tech world having a great day or a terrible day, the NASDAQ's performance is always mentioned right there with it. All right, so we've covered the what, the where, and the how of the market. Now, let's pivot to the most practical and probably the most important part, the you. How does a regular person actually get started in all of this? The best news is it is more accessible today than it has ever been in history. It really just boils down to a simple 3-step path. First things first, you got to set some clear goals. I mean, why are you investing? Is it for a down payment on a house in 5 years, or is it for retirement like 30 years from now? Your goals will shape every decision you make. Second, you figure out your style. Are you going to be more hands-on or more hands-off? And third, you just choose the right type of account to make it all happen. So let's talk about that second step, your style. You could be an active investor. This is someone who really enjoys doing the research, digging into companies, and trying to pick individual winners. Or you could take a passive approach. This is where you can actually invest in an entire index, like the S&P 500, by buying something called an index fund. It's a super popular and simple strategy where you automatically own a tiny piece of all 500 companies at once. And this, right here, is the best part. All the old barriers to entry, they're basically gone. You absolutely do not need a fortune to get started. So many online brokers these days have no account minimums at all, which means you can open an account and start investing with just a few dollars, whatever you're comfortable with. Okay, this brings us to our final section, and I've got to say, it might just be the most important one. We've covered all the mechanics, but real success in investing often comes down to something else entirely, having the right mindset. This quote really just says it all. The market is going to have up days, and it is going to have down days. That is a 100% guarantee. And it can be so tempting to panic and sell when things are dropping. But the key is to zoom out. When you look at the historical data over decades, the long-term trend of the market has always been upward. If you only take one single thing away from this whole explainer today, please let it be this. This is not about getting rich quick. It's about slowly, patiently, and steadily building wealth over a long period of time. It's a game of patience and discipline, not frantic day-to-day action. And that right there brings us completely full circle. If investing is a marathon, you need to know where your finish line is. So I'll leave you with this question to really think about. What are the long-term goals that are going to motivate you to stay in the race? Thanks for watching.